So today I'm going to be showing you why using a mortgage calculator is important when you have clients and you're taking them out on showings and you want to calculate some numbers quickly. Remember, when when a lender gives you a pre-approval, let's say for 300K, that does not mean that your client can buy every home that's on the market that's 300K, right? The reason being is because taxes play a big part in it as well. When a lender gives you a pre-approval for, let's say, 300K, they're calculating the taxes at an estimated amount. So if in their mind the taxes are going to be, for in this example, 2,700 in that area, but your client finds a property where the taxes are 5,000 in that area, well, now they can't buy that home for 300K because the taxes will increase the monthly mortgage amount, right? So it will actually, higher taxes than what the lender calculated will actually knock down the pre-approved amount. So let's do an example here. You see that the home value we have is 300,000. We're saying down payment is 3.5%. Okay. Total loan amount is 289.5, which we don't really need to know that. All right. Interest rate. We're gonna get this interest rate from the lender. Now, lenders don't like to give you the interest rate. You got to tell them, look, I'm not gonna tell or guarantee interest rate to my buyer. I need to know the approximate interest rate for my purposes. They're going to say, okay, they'll give you the approximate interest rate. So let's just say 6%. Loan term is 30 years. Date, we're going to keep the date, today's date and month, right? And then property tax, okay, is at 2,700. It's already calculated an approximate PMI. Home insurance for the year. If you think the home insurance is going to be less than this, and you can talk to the lender, right? Let's just say 1,500 for home insurance, okay? But home insurance is increasing as well. Let's say this property has no monthly HOAs and it's an FHA type loan. All right, now with these numbers, 300K in purchase price and 2,700 in property taxes, right? Let's look at this, right? The mortgage is going to be 2,200, 2,206. Okay, now let's take that same purchase price of 300, but now your client found a house and the taxes were 5,000, right? All right, so now that's 2,397. So that's a lot more money, about $200 more per month. But let's say if they found a home where taxes were less than the 2,700 that the original lender calculated them to be or estimated them to be. So let's just say taxes in that area were $800 per year. Okay, that puts you at 2,047, which means your buyer's purchase price, if they had a max of 2,200, because the taxes are lower, they can actually increase the price. So let's try 310,000. I hope you guys get where I'm going with this, right? So 310,000, but lower taxes at 800, right? Still, that's 2,109. Right? So that means we might be able to go up. Let's try 315 because their estimated mortgage, let's say, was 2,200. Let's try 315K, right? You're still at 2,140, right? Let's try 320. See what that looks like. 2,171. You see where I'm going with this? So we can probably go up to about 325K, even though the original pre-approval was 300K with 2,700 in taxes. Well, if taxes were at $800 per year, we could go up to 325K and still be at that $2,200 mortgage. I hope you guys see what I did right here. If not, reach out to me. Let me know. I'll break it down to you. Let's get it. Heavy hitters.